Hello, everybody. Welcome back. So, today we are continuing the series of microeconomics, and the second topic within this series would be elasticity of demand and supply. So, today we are going to discuss about elasticity, what exactly elasticity is, and how the markets responds to the change in the prices. So, this is how elasticity. We can relate elasticity means something that is changing, right? So, we are going to discuss in a detail. So, so let's begin the topic, guys. What exactly is elasticity? For this thing, I had bought uh, a material to just illustrate the things to you. So this is a mask, and it is having an elastic over here. Just see. So if I can stretch this elastic, it is changing, right? It is dynamic. So it is something that is evolving, that is changing, that is dynamic, right? So and that can be stretched and that can be left loose, right? So this is an elastic. I want you to just picturize it. It will be very helpful for you when we will be illustrating examples, right? So elastic mean change. Elastic means that is always dynamic, right? And there is another thread with myself. I do have one more thread. It's not elastic. So I'm trying to pull it, but it's nothing is happening. So it's constant. It's not variable, right? So inelastic means when something is not dynamic, something is not changing, something is constant, something is against the change, right? So this is inelastic. Elastic means constant change. Inelastic means which is not changing, right? So I want you to just picturize these things in your mind. It because these terms sometimes tends to confuse the students, right? So elasticity measures how much quantity demanded or supplied responds to the change in price or income or other factors. See, guys, what is the effect on the demand? So in microeconomics, generally there are two aspects. One from the side of a customer, consumer, means we are demanding, always demanding something, right? And our demands keep on changing, means depending upon our income, depending on the location, depending upon the time. So our demand keeps on changing. Similarly, there is another side of the table that is always supplying. The producers, the businessmen, they are always manufacturing something. So this person is demanding, this side is always demanding, and this side is always giving. But this demand keeps on changing depending upon the location, time, seasons, income, and psychological things. So many factors keeps on changing this demand. Similarly, this supply also keeps varying. Means depending upon this side, depending upon the consumers, again depending upon the time, how much time they are having, what is the demand, what is the logistic chain. So multiple factors come into play. But the change itself, these changes, why this consumer pull and this push, or the supply part from the side of the businessman, why it is changing, and that change is elasticity, and how much it is changing with respect to price, with respect to some another commodity, with respect to income. Now let's give you an example for this. These all are consumers. They're buying something, but all of a sudden the price increased. So this demand will maybe it may go down. Even it's for example again, if the price goes down, the consumption again increases. So it means something is changing, and that change is elasticity, guys. Elasticity means being dynamic, change, and the change of demand, the change of supply with respect to the change in the price, change in the income, or some another factor. That change is basically called as elasticity. Now I have given you a practical illustration as well, that elastic means change. What is changing? Demand. What is changing? The supply, right? And what are the factors that we are going to discuss? And that change is elasticity that we are going to discuss today. So what are the benefits of learning about elasticity? So benefits are, it helps in planning. It helps businesses to plan the production part. It helps businesses to set the prices. Means if the price is too high, people will not buy. If the price is too low, the demand will increase. Or it can bring it can make the product as a given product. If the price is too high, it can put the product in the category of luxury, products. So we have to, the pricing is very, very important. So it helps the businesses to set the price. It helps the policymakers to put effective tax upon. Means you might have seen cigarettes are taxed very high. You know, the luxury material, luxury goods are taxed very high. On contrary, the necessity items, the items which are really useful for normal people, for the people under BPL line, those are taxed very less. So that taxation is also decided by the government, seeing these elasticity only. I hope this is clear to everybody. Now, elasticity, we are going to discuss elasticity from various perspectives today. So let's start from price of elasticity of demand. Means when the price is changing, what is the effect on demand? Price elasticity of demand means if the price is increasing, what is happening to the demand? If the price is decreasing, what is happening to the demand? So we are going to see the changes in the demand. Elasticity, as I told you, it means change. Elasticity means the dynamic, it's how dynamic the demand is, right? Now, it measures the responsiveness. The alternate meaning of responsiveness could be the change, right? It measures the responsiveness of the quantity demanded to the price changes. Means if the price is changed, what is the effect on demand, right? So we are just going to see the formula in a moment. If the price changes, right, with if the demand changes with the change in the price, that thing is elastic. As I told you, being elastic is being dynamic. So if the price changes, right, and the demand also alters with the price, that thing is elastic. And if the price changes, but there is no change in demand, it is quite constant, it's not changing, for example, right? So it means it is inelastic, right? And one more thing is that is proportional. We are just going to see that in a moment. Now let's see the formula first. Now, guys, I know there are multiple formulas in microeconomics. I'm trying to just minimize the use of formulas, but still are important for the long retention of a concept. For if I tell you that the formula for the elasticity would always be same in all the concepts. It is quantity demanded change, right, divided by the change in price. Now, it is just final minus initial in the quantity divided by final minus initial in terms of price multiplied by the initial price and initial quantity. So this is the formula for the elasticity of demand. So I just want you to remember this single concept. And the formula would be same in the supply, formula would be same in all the other aspects. But I want you to just the the price would come in the denominator part and the change in the quantity demanded would come at the top. I hope this is clear to everybody. All right. Now, coming to the next concept. So if this formula and the elasticity demanded comes greater than 1, if this is greater than 1, and how it would be greater than 1? When this top thing, numerator part, will be more than the price change. It means the price, if there is a small price change, it is really affecting the demand. I will give you examples for this. Now, the price for the good earlier was 5 rupee, and the quantity people were purchasing was 100 numbers. And this was a total expenditure done by the consumers. This is for example, right? After some time, the price went down. And because of that down price, the quantity that was purchased now that increased, that jumped from 100 to 140 this time. And because of this, the total expenditure also increased. So with the decrease of price, when the demand is increasing and expenditure is also increasing, this is called as elasticity is greater than 1. Means demand is really increasing. The quantity that is being purchased have really jumped, right? So it is greater than 1 in this case. I hope this is clear to everybody. Now, how the graph would be made for this? So we are coming to graph in a moment. I don't want to confuse you. Now, let's go for the second thing. So this is what is mentioned over here. The formula for price elasticity of demand would be change in the quantity divided by change in the price. Very simple, right? Now, if this is greater than 1, it means it is very elastic. A small change in price, even 1 rupee change in price can really affect the demand. It is very elastic. Elastic means, as I told you, it's very dynamic. So one very small change in the price would bring a drastic change in the demand. So consumer may stop buying a product. It's that bad. It could be that good that if you decrease the price, consumer can, really increase the demand. They really start buying the stuff. So see guys, you have to see how it can be utilized, right? So it means it is highly responsive, high change, or it is very, very dynamic. A 1 rupee change can really affect. A 1 rupee change upside, downside can really affect your demand. I hope this is clear to everybody. All right. Let's move to the second concept. So when would this elasticity of demand would be less than 1? Means price was 5, quantity earlier was purchased 100, total expenditure was done, that is 500. When the price fell down, the quantity, yes, absolutely it increased, but it didn't increase drastically. It's a very small jump. And the total expenditure is also less. So what I want to say, when there is price drop, right, in demand, the demand increase, but it's not a substantial increase, a very minute increase. And expenditure also went low. Now, you all must have seen the previous video, law of demand. Law of demand means it is price and demand are inversely proportional, with few exceptional, but generally price and demand are inversely proportional. If price increases, demand decreases. If price decreases, demand increases. Right? Now, over here, what is happening? If the price is falling down, the demand should have increased drastically, substantially, but it didn't happen in that way. It increased, but not a big increase. So this is known as inelastic thing. Now let me show you over here. So inelastic means the responsiveness is there, but it's not that responsive. Change was there, but it was a very minute change. So such kind of things are called as inelastic. So always remember, if it is greater than 1, it is elastic. If it is less than 1, it is inelastic. And this concept will be applicable in all the other topics we are going to study. I hope this is clear to everybody. All right. Now, coming back to the concept again. If this is equal to 1, it means proportional. Proportional means if the denominator and numerator are just equal to each other, only then ED will become 1. So it is proportional, right? So there is no drastic change in this. Price was 5, quantity was 100. Expenditure was 500, right? Price went bit low, 1 rupee. Yes, there is a change in quantity, but not that high, and the expenditure also remained the same. So there is no change in the expenditure. There is a change in demand, but not that drastic change. Yes, price fell down. Now the thing is that it is very proportional. Means when price and demand are changing equally with the same proportion. So that is why the word proportional was used over here. It is called as unit elastic. When ED is equal to 1. I hope this is clear to everybody, guys. Any doubts on this? Now, if I summarize all the things, so whenever the numerator part is more then the price means if the price change was 1 rupee and the demand changes, 5 times, 10 times, that is E is greater than 1. It is just if both top and the bottom, numerator and the denominator are equal, it means it is proportional. And if the demand is not that, there is no big change in the demand, only then it will be less than 1. I hope this is clear to everybody. So it means numerator part, when there is no big change in demand, though the price is changing, at that point of time, guys, it is called as inelastic. I hope this is clear to everybody. Yes, we are going to see the examples just in a moment, but I want it first that your concepts should be clear. All right, everyone. Now we are going to see the graphical part as well, but let's proceed further, and then we are going to discuss the graphs as well for this. Now, what are few examples? Let's take an example. Now, salt. So you eat food, your meals every day, breakfast, lunch, dinner, right? One common ingredient that all of you would be using is salt, right? Now, there is no dish that can be cooked without salts, right? So it could be only sweet. Otherwise, salt is used in all the dishes in India, as such, throughout the world. So if today 1 kg of salt is costing you 10 rupee, right? So tomorrow that salt, the price of the salt goes from 10 rupee kg to 20 rupee. Will you stop eating salt? No, there is no way around that you will stop eating salt. You will be willing to pay more as well, right? Because it's a necessity, guys. You won't think about the change in price. So even change in the price, it's not affecting the demand. People won't stop eating it. So this such kind of goods are called as inelastic. So it is inelastic, guys, right? Same goes with the medicine. If you are in hospital or if anyone from a family is in hospital, so if a paracetamol is costing you 5 rupee today per tablet, for example, the same paracetamol is costing you 7 rupee or 10 rupee tomorrow, guys, people will buy that because that is a necessity for them. So even the change in the price is not affecting the demand, right? So such kind of goods are called as inelastic. It really does not matters if the salt price goes up or down. You have to use it. It's a necessity, right? Similarly, even if the salt price have gone down, it doesn't means that there will be a change in the demand, right? So whatever is required is required. You can't compromise on that. But on contrary, guys, over here, luxury goods. These are very elastic, but I want to say, let's let's give you an example over here, a very funny example. So if today, you know, a Rolex watch, the price of the watch increases, will you buy that? You will say, sir, next time it's so costly. Sometime in future, if we have money, we'll buy it. Definitely, it's affecting the demand straight away. You will not buy it. Let's take an example of iPhone. If today iPhone is costing you 1 lakh rupee, right? Tomorrow the same iPhone increase the price to 1.5 lakhs. People may stop buying that product. iPhone is also, under the category of luxury goods. So it's very simple, guys. The same thing can be done from the Samsung mobile phone. So people will wait for a good discount. People will wait for the iPhone to cut down its prices. So yes, it is called as elastic. So when the prices are increasing, it is affecting the demand. People will hold their demand. People will try to, purchase it only during the Diwali sale or New Year sale, right? So this is called as elastic because people are holding their purchases. So yes, this is elastic and it is for luxury goods. Whereas for necessity, it's fine. People, whatever they have to buy, they have to buy. You can't control the necessities. But yes, the luxury good can be delayed, right? I hope this is clear to everybody. These are the factors basically that affect the demand, elasticity of demand. It is availability of the substitutes. We are going to discuss that. The proportion of the income spent, right? Necessity versus luxury, right? And the time period for the adjustment. Now, let me give you a small brief on this as well. Guys, I know, all of you love tea, right? Tea lovers are tea lovers and coffee lovers are coffee lovers. And if I give you an example that if the price of the tea goes up and the price of the coffee goes down, which one you prefer? So tea lovers would prefer only tea. But just for an example, this is a very common example in economics. That for example, if the price of tea goes up, people will start drinking coffee. It's as simple as there is a substitute, right? There are two types of goods, substitutes and complementary. So over here we are talking about substitutes. So if the price of coffee goes up, I will satisfy myself with a cup of tea. So if there is availability of substitute, guys, your consumer will shift from one product to another product. So if the price, so again, it is elastic, means if the price of tea goes up, the demand of the tea will go down and people will switch from tea to coffee. So this is called as availability of the substitutes. I hope this is clear to everybody. So over here, there's so many vegetables, right? So if the price of one vegetable goes up, people will switch to another one. No issues at all. So they can wait. This is something, it's called as elasticity, right? Now, necessity versus luxury, that I already told you. Necessity versus luxury. This was the example for that. The proportion of income spent. See, guys, purchasing power play a very important role in terms of demand. The best example, the recent example for this was that India right now is facing unemployment as well. Along with that, the people earning power, the per capita income for the people of India is quite low, right? So they're not spending money. And where you can see that people are not taking loans, they are not buying houses on loans, they are not purchasing cars. So the economy is also stagnating because the income part has gone down and people are facing a lot of taxes from the side of government. So there is no free cash left, you know, in the hands of people. So if government reduces taxes, guys, the income part, the free income, the free cash will increase in the hands of people and they will start buying things. So the proportion of the income spent will increase and that will definitely increase the demand of the commodities, right? So again, it is very important. It affects the demand. So income also play a very important role. Now the time period for the adjustment. See, guys, if it is a necessity, if the time in your hand is very, very less to buy something, for example, you are having exam after 2 or 3 days and your laptop goes is facing some malfunctioning, then what can you do? You have to purchase either a new laptop, you get it repaired, right? I think that it depends upon the time. If you have good amount of time in your hand, you may wait for some time. But if you don't have the time, you have to buy it. It could be the seasons as well. So seasons also affect the elasticity. So in summers, you have to buy the AC regardless of the price of the AC. So again, it is affecting the elasticity. So what is the time you are having in your hand, time period, right? That is also affecting your elasticities. Now, price elasticity of supply. What does it mean? Now, we just discussed with respect to a consumer, a customer, just a moment back. Now we are discussing from the terms of a firm, from the side of a businessman, from the side of the producer, right? How they are supplying. This was the side of consumer who were buying, and this was the side of the producer who was selling or who was supplying the commodities, right? So again, with the price, they also think quite differently, guys. The suppliers, you know, let's give you an example. So law of demand and law of supply, they work opposite to each other. How it work? If the price goes up, let's take an example of any commodity. If the price goes up, people will stop buying that thing or people will decrease the purchase of that thing. So price and demand are inversely proportional. Fine. On contrary, vice versa. When price goes up, the the manufacturers, producers, or the businessmen, they increase the supply. So price is directly proportional to the supply. Why they increase the supply? Because they want to earn more and more profits over here. So law of supply with the price, supply is directly proportional. According to law of demand, with increase of price, it is inversely proportional. I hope that is clear to everybody. So measures the responsiveness quantity supplied. And who will supply this quantity? The businessmen, the producers, the firms, the manufacturers to the price change, right? So concept is same, but it is we are seeing the effect of price on supply from the side of businessmen, firms, producers, or manufacturers. I hope this is clear to everybody. Now, what will be the formula for this? Again, the same formula, guys. Over here in the numerator part would be suppliers and denominator would be the change in price. So quantity change, the percentage change in the quantity supplied divided by the percentage change in the price, right? Now coming back, same concept, percentage change in the quantity supplied. It is just similar to this formula divided by the percentage change in the price. So if I switch it, right, it will be like this, guys. So this is the quantity supplied, change in the quantity supplied, final minus initial divided by the final price minus initial price multiplied by the initial price and the initial quantity supplied. See, it is very, very similar. This is ED, this is ES. Elasticity of demand, elasticity supply. The concepts are very, very similar, guys. So we are seeing two aspects over here. One, consumer, consumer's aspect. Second aspect is from the side of the supplier, right? Now, if it is elastic, it means greater than one, right? Now let's see. So as if we put the values in this formula only, if I put the same value in the denominator, if there is a change in price and the quantity supplied increases quite substantially, so it would be greater than one. So denominator is changing a lot. So there is a big change, right? The same concept what I told you over here, right? Similar concept would be there. So it would be greater than one. ES greater than one. I hope this is clear to everybody. So it is very, very responsive. Now, similarly, if it is less than one, right, it is inelastic. Nothing is happening. So the same thing, the denominator part is having more substantial share over here, and there is no change in the denominator on the top part. So it is less than one. So it means it is not that responsive, right? So elastic means greater than one. So it means it is very, very responsive. A small change in price will affect your supply a lot. On contrary, if it is less than one, a small change in price will not have that impact on the supply. I hope this is clear to everybody. Now, guys, in the if I give you a small brief on this, time plays a very important role in terms of supply side. Let me give you an example for this. For example, you have very short time, right? So in that short time, if I ask you to increase the production, right? So to increase production, what you need machinery, you need land, you need labor, like that, right? But you can't purchase machinery immediately. It's not short term. You can't buy land or factory immediately. It's not short term. The best thing you can do is to hire more and more labor, but that only for short run. So in short run, it's very difficult for a company to increase the production, right? In long run, on contrary, you have a lot of time to increase your production. You can employ more labor, you can buy more land, you can buy more machinery, you have ample amount of time, right? So in long run, you have a lot of time to plan, a lot of time to think, right? The farms can adjust fully, and it's highly elastic. Means you have a lot of time to increase the supply. You have good time to plan. You have good time to use capital budgeting. You can buy more machineries, land, you can employ more labor. But in short run, guys, it becomes a bit limited. Means you can't buy new land, you can buy new machineries, take a lot of time, right? You can employ. So there are very less variables over here. Only labor is the variable that you can really change drastically. And that too, there is a marginal concept comes over there. If you increase the labor too much, again the output starts declining. That we are going to discuss in a different class. But I want to say, it is just like that marginal law of utility. More labor you will employ, the output starts decreasing afterwards. So it's not that flexible. Anyhow, it increases the output, but it's not, you don't have that much time to increase it, right? So time play a very important role in terms of supply, guys. I hope this is clear to everybody. All right. Now, what is cross price elasticity of demand? It's very interesting. Again, the example of tea and coffee. So, guys, there is a cup of tea and there is a cup of coffee. Again, so very common example in microeconomics. So, what would happen over here is that if the price of one commodity starts increasing, it's going to affect the price of another commodity. Now, let's come to the definition over here. It measures the responsiveness of demand for one good to the price change of another. Now, if I am consuming coffee every day, and all of a sudden, if government starts imposing, more taxes on coffee, or if I don't find good coffee in India because of some ban or some quality checks imposed by the government, so I can easily switch to tea. I know, tea lovers would love tea more. Coffee lovers would love coffee more. But for the sake of example, what would happen? So it says that if there is change in the if there is change in the price of one good, it's going to affect the another basically. So the formula for this, change in the quantity demanded of good A to the change in the price of good B. So it is relation for the both goods, right? Now the best example for this is positive substitutes, that is tea and coffee. Best example, guys. So over here we are substituting one good from another. See, guys, there are two types of good in terms of substitution, in terms of cross price elasticity. One good is substitute, where I am replacing one good with other, right? So if not tea, then coffee. If not coffee, then tea. So I'm replacing, I'm changing, I'm switching from one good to another. And both are giving me, similar kind of satisfaction, basically. But there is one more type of good, that is complementary goods, substitutes and complementary. Complementary means if the price of one is getting affected, it is going to affect the demand of another thing. Now let's give you an example, guys. So that is why it is giving negative effect. Let me give you the example for this. Why this is positive and negative. If the price of tea goes up, right? So I will stop buying tea. And similarly, like me, there's so many people who will stop buying tea and they will start buying coffee. So the demand of coffee will increase. So it is called as positive because you know because of this one product, the demand of another product is getting increased. But on contrary, on the complementary goods, if the price of one good increases, people stop buying another good as well. Now, if the price of petrol really goes very high, for example, it goes up, anyhow it is right now very high, but just imagine it crosses 100 as well. People will stop using cars. People will, start carpooling, or people will, avoid using cars so frequently. So what is happening over here? One product, the price of one product is affecting the another product. So if the price of fuel goes up, people will stop buying cars, or people will, start, stop using cars that frequently. So it is having negative impact, guys. So because of one product price change, the price, another demand of another product is also affecting. So I hope this is clear to everyone. That is why it is positive and negative. So substitutes, people change their product. People jump from one to another, and the demand of another increases. But in the case of complementary goods, if the price of one good increases, it decreases the demand of another good. So it is having negative impact. I hope this is clear to everybody. All right. Now, one more thing, the graphs were remaining. Let me show you the graphs, guys. We don't need to discuss all these graphs, but first three graphs are very important, guys. Now, coming to the perfectly elastic, right? When the price is constant, but the demand is changing. So it is horizontal towards the horizontal line, towards the x-axis. Whereas in perfectly inelastic, guys, is very interesting. The price is, you can say, the quantity is always you will be buying the things. Even the price is changing. I mean, for example, if the price of medicines is changing, regardless of that, people will not stop buying the things. If the price of salt increases or decreases, people will buy it because anyhow they will be buying. So this is perfectly inelastic. So this is vertical, guys, perpendicular to the horizontal x-axis line. You just have to keep one, how to remember this thing for the school going students or the students who are in plus one and plus two, or who are in their bachelor's degree. Just put one thing as constant. So if the demand is changing with price, so it is elastic. If the demand is constant, even the price is changing, it is perfectly inelastic. I hope this is clear to everybody. Now, what is proportional? Proportional means, guys, if the price and quantity, they are having similar kind of change. So this is the diagram for this. And why it is negative, why it is slope is downwards, because this is the law of demand. Law of demand means if the price increases, the demand starts decreasing. So this is the law of demand, and this will be like this only. I hope this is clear to everybody. Now, this we are going to discuss just in a moment. The similar diagrams, I don't want you to cram, but I just want you to keep this in mind. The similar diagram is for the supply as well. So if the supply part is elastic, so the diagram would be same. In the case of x-axis, here it was demand, it was supply here. So over here, what is happening? The supply is changing, the price is constant. Similar to this one, right? Because it is elastic. In elastic, even the supply, even the price, whatever the price is, the supply will keep changing, right? Now, in case of inelastic, guys, it is just similar to this. So what is happening over here? The people, the producers, they're just selling, they're just supplying the things. So supply, whatever, the price changes, the supply keeps on, it's constant. Whatever is being supplied to the market, it will be supplied. And why this is for the proportional thing now, guys. It is why it is different over here, the price and supply. See, guys, as per the law of supply, if the price increases for the firm, the supply also increases. I want you to see the video of law of supply. We have just completed it, guys. So how it works basically, whenever the prices of any commodity increases for the suppliers, for the producers, I'm saying, they supply more. Why they supply more? Because they start earning more and more profits out of this. Now, we will be discussing these diagrams in a moment, but and these are not required as such because these are a bit high level. I want you to at least know these diagrams, right? Now, one more thing I would like to say over here, if the price of the commodity is increasing, right? So how I can, being a producer, how I can earn more and more profit? So for this, the best example would be this pen, right? The cost of this pen for me was 10 rupee, right? And earlier the selling price was 20. I was making 10 rupee profit margin. Now the cost remained the same, but just imagine the selling price of this pen went from 20 to 30. Now being a firm, I am making 20 rupee margin. My profits are increasing. I hope this is clear to everyone. So if my profits are increasing, I will tend to supply more into the market so that people buy more of it. So I will use my stocks as well. My inventory, I will use all my stocked inventory and I will sell all of that at more and more profits. So this is how it works. So for a supplier, for a person who is producing, if the market price increases of that commodity, I will supply it more. I hope this is clear to everybody. Law of demand. Now, income elasticity. Guys, income play a very important role in terms of demand. And in India, we are very price sensitive market. We need good quality and we need at good quality at a less price as well. We are very price sensitive and we are very conscious people, right? Now, income elasticity of demand means it measures the responsiveness of demand changes to consumers' income. Means if income of consumer goes up, what is the effect on demand? If income of consumers is low, what is the effect on demand? And guys, this is a very important concept. This is what government of India is planning to do now. Now, what exactly have happened? And they are just going to change this elasticity basically. Now, what is happening in India? First, there is a big unemployment thing in India right now. People are not earning money, so they don't have income, so they are not demanding. First thing. Second, if someone is earning in the family, they are very highly taxed. The income tax rates are high, GST rates are high, so people are having no cash in their hands. Again, it's affecting the demand. It means income, and one more thing, guys. People are not having money, so they have stopped buying durable products. Durable products is a good parameter of the growth of the economy, like washing machine, fridge, all the durable commodities, automobile, household sector. So this is a very good parameter of economy. So people are have there is a decrease in all these things. Even you might have heard interviews of uh, Godrej Consumer, Nestle. They have said that their consumptions have gone down. Why? Because people have stopped buying their products. Why? What is happening? Because income has gone down. So if government decreases the tax rate, people will have more money in the hand, they will buy more, it will affect the demand. So just see how much income plays a role in terms of demand in national level as well, macro level as well. So It is a change in the quantity demanded with respect to change in the income. So absolutely there is a big relation between both of them. So if it is positive, is it negative or is it, greater than one? We are just going to see. Now, before this, we need to understand few more concepts. There are luxury goods. Luxury goods, you all know, luxury goods are goods that are really costly. It could be, like Rolex watch, Lamborghini, all these companies are luxury companies. Then comes inferior goods. What are inferior goods, guys? Giffen goods are also part of inferior goods. As the name itself suggests you, it's not inferior in terms of inferior, but these are the goods which are really very important, like salt, like necessity things are inferior things, right? Like bread, wheat, these are inferior things. Normal goods are normal goods, means which we generally buy the normal commodities, right? And what exactly happens over here is that the income affects the demand in a big way. Now, what would happen? For example, in terms of luxury, in terms of negative, in terms of positive effect, in terms of inferior goods, in terms of normal good, it will be having a different effect. Now, let's see how it works, guys. Now, what would happen if income goes up, right? If even if my income goes up, would you buy more and more salt out of that? No, right? That is constant, if I say, right? So if income goes up, you stop buying inferior goods. Means you stop buying eating, simple rice. You may eat basmati rice now. So that is why it is negative. So it is having a negative effect on this inferior goods. So the demand of this, it either remains constant or you may switch to some another good. If income increases, you may switch from here to luxury goods or from here to normal goods. But the thing is that over here, what is happening? The demand of inferior goods, it is having opposite effect on the income. Means income is having opposite effect on the inferior goods. So, for example, let's take example of rice. You earlier used to eat rice 10 rupee per kg, a normal inferior good, just for the sake of necessity you were eating that. Your income increased. Now you will try to increase brown rice, healthy one, healthier one. You will try to increase basmati rice. You will try to eat basmati rice, better rice, right? 100 rupee kg, 200 rupee kg. Now the effect is that the demand of this inferior good is getting decreased. So that is why it is negative. In terms of positive, these are normal goods, guys. It will having a positive effect. Means if your income increases, you will buy more and more stuff. All the other goods, all the goods, normal goods, all the goods on day-to-day life, these are normal goods, right? You may buy good shoes, you may buy mobile, you may buy, all the day-to-day stuff. These are called as normal goods, basically. So it is positive. I hope this is clear. Now, luxury goods. Why it is getting increased again greater than one? Because guys, now earlier you were using Xiaomi mobile phones. For example, your income goes really up. It's from 20,000 to 50, then 60, 70, 1 lakh, 2 lakhs, like that. Now you will switch from a normal good to a luxury good. Earlier you were using a motorbike, you will buy a car. You were using a Chinese mobile phone, now you will buy iPhone. You were using simple laptop, now you will buy a MacBook. So the thing is that luxury good demand also gets affected with income. So income also play a very important role. Yes, it affects elasticity. It changes the demand. I hope it is clear to everybody. Now, guys, elasticity demand. See, guys, how it is affecting the revenue of the company. Again, I told you, if the prices are lower, it increases the why impact on the total revenue, right? Elastic demand. The lower prices increases the revenue. Inelastic demand. Higher prices increases the revenue. So it is written, something is wrong over here. It must be decreasing over here. So what is happening over here, guys? This I already told you that if from the supplier side, what is happening? If the market prices goes up, they will supply more to earn more profits, right? Because I just gave you an example of a pen. So if it is, it had the cost price of this pen was 10 rupee, the manufacturing price was 10 rupee, and I was selling it 20 rupee to the market. So my revenue was 20, for example. Now, all of a sudden, because of inflation or because of some another condition, the price from 20 to it became 30. Now my revenue became 30 rupees. It increased. My manufacturing cost was again 10, but my revenue increased. So yes, it affects the revenue of the company. So being a producer, I would expect the prices to go up. Huh, but I would be expecting that my manufacturing cost to stay constant. I hope this is clear to everybody. Now, what are the factors and determinants for the supply part? It is time. I told you time is very important. More the time in your hand, you can increase the production. If you have the less time, the variables could only be labor. So it will be very difficult to increase the production by labor. Yes, absolutely. With as the number of the laborers they are increased, definitely initially the production is increased, but once it hits the plateau, it starts going down. So even the overemployment doesn't help in a company. It's just you have to see all the parameters. Flexible availability of the resources, absolutely more resources, you will be having more supply, you can produce more products, you can produce, right? Flexibility of the production processes. See, if you have two or three processes aligned in your company, so you can use all those things to increase the supply. This is we are seeing with respect to not from the side of consumer, but from the side of supplier. And spare production capacity. This is the inventory. So if today raw materials are cheap, if today all the conditions are in your favor, so produce as much as you can, increase the inventory. And you have an expectation that after 1 year or after 5 years, the cost, the selling price or the market price of that product would be very high. You can increase, you can store all the things in your inventory, in your stock, so that after the prices goes up, you can sell it. You can earn more profits out of that. So this is how the big companies they use this data. Now, what are the practical applications? So definitely, guys, the practical application of all this, whatever we have studies, would be, it helps to make the pricing strategies, right? It helps the bundling of the products. Bundling of the products means you can bundle two products together, like powdered milk with coffee, powdered milk with tea, like that. So you can bundle two or three products. You go to market, you might have thought that today I'll buy a pair of shoe, but when you are out in the market, you found good discount with a pair of socks as well. So you can bundle the things together, right? It helps the governments to predict, in which commodity what tax they should be, imposing basically. So so the use of studying elasticity is, how a small change in price can affect the demand. So, shortlisting the exact price, fixing the price for any commodity plays a very important role, right? For any company. So, if everything is going fine and all over, suddenly company changes or increases the price, it can really impact the entire business. People may stop. If it is so elastic, people may stop buying the products and they may jump from one product to another product. So you have to see when you are starting a business, you have to see your product is elastic or not. If it is elastic, then a small change in price can really affect in a bad way. I hope this is clear to everybody. So let's have a look on these practical applications, guys. Now, price elasticity of demand. So it is something related to demand. So if the price is changed, will it affect the demand or not? Let's see a few examples. Petrol is inelastic. How? See, guys, you are having a car and you go to your office or your school using that car, right? Can you avoid using petrol? Can you stop using that car? You may for some time, but guys, if it is a necessity, you can't. Same goes with India as well. India has to import a lot of crude oil, a lot of crude oil. Uh, Government has to do a lot of expenditure on crude oil, guys. It is having inelastic demand. Even the prices of petrol goes up, people have to buy it. It's a necessity, right? So petrol is an essential and it is having inelastic demand. Even the prices goes up. Luxury items, as I told you, like iPhones. When the prices goes up, people stop buying it. People can delay the buy purchase. If not today, maybe in the sale time, maybe during the New Year time, maybe during the Diwali time, right? So you can buy during the sales time. So the thing is that consumer they are very price sensitive, but only for few products. Few products they have to buy if it is necessary, right? So consumers quickly switch to alternatives for elastic goods when the price rises. So guys, whenever you're starting your own business, you have to be very careful. You have to see whether your product is elastic or not. If it is elastic, a small increase in the price and you can lose your customers. So it's very, very important. You can decrease the quantity which you are selling. Means you can decrease the size of the product. Earlier you were selling 50 grams of biscuit, you can decrease it to 40 grams, but you should never increase the price. The same was done by Parle-G, the same was done by Lay's, the chips, right? What they used to do. Earlier they used to sell 50 grams of Lay's at 10 rupee. Now they did increase the price, they decreased the quantity. Now they are selling 40 grams at 10 rupee. Then they will do, 30 grams at 10 rupee. So this is how they can change the price. They're not changing the price, they're changing the quantity of the chips. If they change the price from 10 rupee to 20 rupee, people will stop buying it. So this is how these companies, they know the elasticity. This is very important. Now, income elasticity of demand, how income can affect the demand. And luxury goods like BMW, see higher demand with the income is increasing. Guys, this is very important. If your income increases, your standard of living increases. To increase the standard of living, you may do some kind of shop to your friends, you buy some luxury goods, to enjoy, to have more satisfaction of life. So luxury goods demand increases with increase of income. On contrary, the inferior goods like instant noodles or, as I told you, normal desi rice, their price may decrease, their demand may decrease. Now you will be eating, basmati rice, brown rice like that, which are 500 rupee per kg or 400 rupee per kg. So this is how these things play a very important role. Even tourism industry fluctuates with income changes. So what happens when you are a college student, you have very less money, but you have a lot of time to travel. It's so, uh, it's a very contrary thing. When you have a lot of time, you don't have money. When you have money, you don't have time. So in your college days, school days, you don't have money, but you have a lot of time to travel, but you can't travel. Once you get into job, you don't have money, but you have money, but you don't have time. So tourism industry, it increases with income changes. Means if you earn more, you will travel more. Travel that too, quite in a comfortable manner. So it's very important. It's very good, right? So cross elasticity of demand. So what happens, guys? Pepsi and Coca-Cola are substitutes. So if Pepsi will increase its price, people will drink Coca-Cola. If Coca-Cola increases the price, people will switch to Pepsi. So, they're switching actually. So it is cross elasticity. One product can affect another. So these are substitutes. So these goods are called as substitute good. There are another complementary goods as well. Fuel and the cars. So what happens over here? If the price of fuel increases, guys, right? The car, people will stop using car. People will stop buying car. So these are very, very, they are affecting each other. So these are called as complementary, which are used together. I hope this is clear to everybody. Now, price elasticity of supply. Now see this from the side of suppliers. Guys, only remember one thing. All the agriculture commodities, right? They are inelastic. And why they are inelastic? Guys, to grow wheat, to grow rice, it may take a specific time, maybe 6 months or 1 year, right? So even for example, I am a farmer today and I grew 10 kg of rice, right? And I was expecting 10 rupee per kg, very, very less. But all of a sudden, the market demand went so high for the rice, people are willing to pay 500 rupee per kg. Just imagine. I was expecting 10. They are paying me 500. Now, from where I can produce more rice? I already had 10 kg of rice. Means I produced from my land only 10 kg of rice. So I can only sell 10 kg. It's not something I can manufacture. Even if I start growing today, it will take 1 year for the crop to grow and then I can reap the crop. It will take at least 1 year. So guys, even I am wishing to sell more, but I can't sell. because to produce agriculture commodities, it takes time. It is time dependent. It's a cyclical, long production cycle. So that is why all the agriculture products, in terms of supplier side, they are inelastic. So wheat is the example for that. So if today people are willing to pay more price for wheat, and being a farmer, I can't grow it immediately. It will take some time. So whatever quantity I am having in my hand, I can send only that. On contrary, smartphones have elastic supply. Means we have economies of scale, and we can quickly produce those things. So I hope this is clear to everybody. Okay. Now coming to elasticity, different market structures. Again, very important, a very interesting thing. If it is perfect competition, guys, it is very highly elastic. How? Let's see Zomato and Swiggy. If Zomato increases 1 rupee price, it's good for Swiggy. People will start using Swiggy. So if Swiggy starts giving discount, Zomato also have to give discounts. See how elastic they are. They're fighting for one rupee, guys. So if the competition is perfect competition, so it is very highly elastic. And being consumer, it's good for us. Same happened during COVID. That Uber and Ola. Uber was giving immense amount of discounts. A big company, guys, MNC company, and it just removed Ola from the business itself. So because they were giving immense amount of uh, discounts, and those discounts, it was very difficult for Ola to sustain for a very long period of time because of the perfect competitions. Whereas monopoly, it's inelastic. Why? The best example is Jio. Jio can charge more money from you. You have to. You don't have any option. You don't have better alternative to Jio, right? You can't use BSNL. You can't use other companies because you don't know what kind of quality they are going to give. So Jio is something which is inevitable now, and it's a monopoly, and it's inelastic. They can charge you as much money as they want. I hope this is clear. So monopoly is an inelastic thing, and perfect competition is highly elastic. I hope this is clear to everybody. Now, guys, what is the benefit of this? Again, it is beneficial for giving taxation, deciding taxations. It is beneficial for giving the subsidies. All right. Now, how the elasticity, demand, and the supply is affected globally? It is affected by the currency fluctuations, guys. Because of the currency fluctuations, prices vary. The same iPhone can cost you 1.5 lakhs in India. The same iPhone can cost you 80,000 in terms of Indian rupee in USA. So see, the prices are different. So demand would also be different, right? So it affects the exports. It affects the imports as well. So this is how demand can be fluctuated world global level because currency conversion rates come into play. So prices are dependent on conversion rates of currency. I hope this is also clear to everybody. Okay. Limitations. See, guys, there are some limitations that whatsoever we are studying, that is something theoretical. And when we see in the ground level, practically things may happen differently. This is the only limitation you can have. And collecting data is also very difficult sometimes, right? So guys, summary terms, if I say elasticity is very important in terms of in terms of decision making with respect to the company, with respect to the government, right? And it is important for fixing the price of a commodity when you starting a business, for taxation and for the subsidies as well, right?